All right, ladies and gentlemen. Hopefully you can hear me okay. We've got about 6 minutes until we officially start. Just want to make sure that you can all hear me. If you can't hear me, do let me know in the live chat. But as I said, we'll be starting in about 6 minutes time officially. So just a reminder as well, there will be quite a bit to cover before the Canadian release today that we have. All right, so we've got about a couple of minutes left, and weather here in the UK, in London, is pretty. It's boring. It's still cold. Hasn't got any warmer. So it's just living with this cold weather. But other than that, we're all good on my side here. It's also, anyways, we're getting close to the summer, so hopefully we get a bit more of the warm weather in the UK. So about a minute to go until we officially start then. All right, so just to make everyone aware as well, before we are due to start, we did have some earlier headlines from the Kremlin saying that Russia's special operation in Ukraine could be completed in the near future if goals are met and work by the military in peace negotiations is completed. So for the back of that, you did see Dixie weakening, and then also if we're looking at other areas too. So go to the S&P 500. If we go back to the time, it only came out 6:15 a.m. Eastern time. Let's just measure it up. Okay, so there was a bit of a movement towards the downside on the Dixie and the S&P 500. Gold had seen a similar movement towards the downside. Gold had seen a bit of a pop towards the upside. WTI crude oil, a little bit of a movement towards the downside, but I think overall it was continuing on WTI its trend of trading within or heading lower. So crude currently down about 0.6 on WTI crude oil. So the USD Canadian dollar, that's currently flat at the moment before the release. And let's begin this prep. Okay, so the Canadian Employment Report, why is it key? So one of the main reasons, so the employment, what it does is it measures the change in new jobs being added and includes both full-time and part-time workers. The unemployment rate measures the number of unemployed as a percentage of the labor force. So similar to the US non-farm payrolls release, you would have the employment change, which would be provided, the data would be provided by businesses to the government or to those being surveyed by the government, and then vice versa. And then on the flip side, for the unemployment rate, you'd have the Canadian version of their household survey, asking about how, if people are employed, if they're part-time or in full-time work. So just it's basically the same as the US, but just on a slightly smaller scale, but still important nonetheless for trading in the markets. And can be a nice trade, depending on how good or bad the figure is. So the next point, so how does it affect the markets? So with currency, if we have a better than expected data for the Canadian employment change and also the unemployment rate comes in lower than expected, then you would usually see the Canadian dollar seeing strengthening off of the back of a more positive report. For bonds, if we're in this tightening cycle that we're currently in at the moment with Bank of Canada, and of course they have their interest rate decision next week where they're expected to hike by 50 basis points, and that's what markets are expecting overall. Then for bond prices, you would, with better than expected data, you would potentially see them going lower, and the yields on those bonds would go higher. The key reason being that if bonds, you've got to remember, the better the economy is doing, the more, and of course, if interest rates are raised, that will raise the yield of those bonds. So bond prices, so you've got to think about supply and demand. The higher the yield is, the lower the price is, to try and attract traders to jump into those yields. But also, of course, when rates are raised, that's also one of the other reasons why yields increase as well, particularly on the short term, on the shorter term bonds. For stocks in the stock market, so it's something that doesn't really get too much of a look at or focus of. It's the Canadian dollar currency. For stocks, usually in a non-tightening cycle where the economy is starting to expand and the central bank isn't looking to tighten policy, then usually that can be quite positive for stocks. But in a tightening cycle, usually for stocks where the central bank is looking to withdraw monetary policy, or let's say reduce or cut their balance sheet, as we have with the Federal Reserve or what they started, then usually for stocks that could potentially be a negative, where higher interest rates in a tightening cycle could mean lower corporate profits. So the previous report, 336.6k or 337k, if you want to say, new jobs were added in February. Remember, this is measuring the net amount of jobs that have been added in the economy. It doesn't show how many jobs were lost, which doesn't really get shown in the Canadian release or Canadian releases, whereas in the US we get the JOLTS data or the job openings and labor turnover data that we get there, which provides a much clearer picture of where the employment situation is. But in Canada, it just provides the net amount of jobs being added to the economy. So it's much better than the forecast in the prior release. A forecast was 127k and had about 200k deviation or 211k deviation there. Prior figure was minus 200k, so it did smash the prior January report that we had seen in Canada. And also the unemployment rate fell to 5.5% from 6.5% in January, and that's the first time that the jobless rate had fallen below its pre-COVID level. Now it's near a 5-decade low. The reports also showed that the economy is back up against what the Bank of Canada believes is full capacity, and will reinforce expectations for as many as 6 more interest rate increases this year, after the central bank began a hiking cycle earlier in the month of March. So again, you've got the jobs or the labor sector or the labor market that is very tight. The unemployment rate is going lower. You've got more people that are spending money or have the ability to spend money with the jobs that they have been given. So that's playing to the hand very strongly of the central bank looking to hike interest rates by a stronger amount, i.e. with a 50 basis point hike. We'll go into that in a little more detail later on. Does anyone have any questions so far? Is anyone confused? Is everything clear, crystal clear? Hopefully it is. If not, do let me know in the chat and we'll go through it again. We've also got the deviations, the prime market reactions to go through. Okay, so where is the economy at the moment? So inflation rate is at the highest since 1991 at 5.7%. GDP was also better than expected, better than the bank or the central bank had predicted at 6.7%. That's the annualized data to finish the quarter of 2021. And then GDP month on month at 0.2%. So the overnight rate, of course, was hiked from 0.25% by 25 basis points to 0.5% on March the 2nd. So again, the hiking cycle has already begun. Now, oil prices has been quite key for the Canadian dollar and has been quite positive. And we'll look at the charts as well as to why that is the case. But the surge in oil prices over the past year has helped the Canadian economy see a surplus for the first time since 2014. So the energy exports rose by 7.8%, and that now accounts for about 26% of total shipments during the month of March, which is the highest proportion since 2014. Now, a lot of that, of course, is to do with the Russia-Ukraine conflict, adding some pressure in the commodities market and seeing higher prices where oil whipsaws by quite a bit, and seeing oil, staying above $100 for quite a bit of the time. Although today it is below that, about $97. But but because of that fluctuation in oil prices, and seeing that Canada's economy, about 17.5% of Canada's economy is made up of providing oil to other nations, that has factored in quite well for the Canadian dollar itself as well. So one of the other things that I wanted to go through is show you as well is just the triggers that we have for today. So expecting high, well, according to economists, their high estimate is 125k with a low of 0k. And with the unemployment rate with a high estimate of 5.6% and with a low of 5.2%. So just one other, if we go to look at the, if I bring it up here, we'll look at the forecast figures that we have. So for the Canadian employment change forecast is 79.89k with a prior of 336.6k. The Canadian unemployment rate forecast is 5.35%. With a prior of 5.5%. And then if we're looking at the Canadian average hourly earnings as well, something to bear in mind for the central bank when they're looking at wage, when they're looking at how much or what is the wage, current hourly wage that Canadian consumers have. That's the prior was 3.3% with an forecast of 3.7%. So remember, if inflation is higher than wages, then that's not a positive sign. So the only way for the economy, as consumers are spending more than their money is actually worth. So the central bank would need to try and do something to curtail inflation, try to bring it down. Now, there are different environments where interest rates are raised for different reasons. But currently at this moment, what we see is that if inflation is too high and the price of goods is quite high, then something needs to be done to bring down or cool the inflation, cool inflation in the economy for the time being, or to bring it back to normal. So here we go. So this is what I wanted to show you guys. So one of the sentiments is important bits of sentiment, as I just explained. So the loonie trading higher as crude prices appreciate. And we can see here in this image. So this is the Canadian dollar compared to WTI crude oil. So WTI crude with the orange line and the Canadian dollar itself there. If I bring it up on a chart for you guys to have a look at, that'll give you a much clearer indication as to why when we see this appreciation in crude oil prices, it helps the Canadian dollar. I will show you right here. Okay, let's go to a day. All right, there we go. Perfect. So perfect. So as we've seen, when crude oil prices see a rise, the commodity-based currencies, particularly the Canadian dollar, they see an appreciation. Now we can see that there was the spike here in crude oil prices at $124.50, and then about 30 days later, or about a month later, we had seen the Canadian dollar seeing its peak later on after the initial spike. So what I'm trying to show you here is that with oil prices and the current sentiment that's driving the markets, that is currently helping to boost the Canadian dollar. Could that mean for the release itself that we do get a strong reaction? Well, that's going to be that's why we want to have a look at our deviations. But potentially, if there's usually when there's positive or negative news that comes out from Ukraine-Russia conflict, that can derail economic releases to the point where they don't matter anymore to the markets, and they bear no significance or have no reaction. But that's one thing to be aware of. Today there hasn't, as said, there was some news where the Dixie was seeing some downside movement off the news that the Kremlin. Off the news that the Kremlin said the Russia's special operation in Ukraine could be completed in the near future if goals are met and work by the military and peace negotiators is completed. So again, looking at a more positive situation between Russia and Ukraine, or slightly more potential situation. So from off the back of that, we'd seen, and as we can see with the market reaction, we'd seen that Dixie see some movement towards the downside there. So overall, the Canadian dollar slightly up today, still near enough flat, but still slightly higher, slightly higher on the day so far. So going to back to this here. So more rate hikes are expected. Again, so some economists see half a point hike. So Scotiabank, RBC sees a 50 basis point hike next week, April 13th. Of course, with the Fed now projected to normalize monetary policy much more quickly, and the Bank of Canada not opposing market pricing for a more aggressive rate path, they have accelerated the tightening that was previously expected in 2023. So that's according to RBC's what they're expecting. They've accelerated the tightening that was previously expected in 2023. So you've got markets bearing in mind that with employment data, it's quite important that, as said, with the better than expected data can lead to more consumer spending as they have more money in their pockets, but then that can lead to higher inflation, and that can lead to a stronger reaction from the central bank to try and control the issues of inflation overheating. And then, of course, as said, you have the Ukraine conflict whipsawing safe haven assets. So now what we've usually seen in the past, when the dollar sees a depreciation, the other dollar-denominated currencies, such as the Canadian dollar, New Zealand dollar, and the Aussie dollar, see an appreciation. A lot of it being is that if paper money is seen as not to be as attractive, or the dollar is not seen to be as attractive as a safe haven asset, then usually what happens is that's usually in a risk on environment where there isn't a need to jump into safe haven assets. What happens is that those commodity based currencies that are seeing more value in, let's say, in crude or in gold, then that helps to boost appreciation in those commodity-based currencies for the Canadian dollar, the New Zealand dollar, and the Australian dollar. And as we've seen clearly here, with crude oil prices whipsawing as one of the key commodities that Canada provides, that's helped boost oil prices. Boost the Canadian dollar, as we've seen crude oil prices increase. So that's the current sentiment under the moment, that the Canadian dollar is being pushed by the Ukraine-Russia conflict. But also, we have other bits of news too, with the Saudis, and you've got China with their COVID situation, where the market has been up and down. So Canadian dollar is still following, has WTI crude oil is a good indicator of where the Canadian dollar at the moment could be headed. So Bank of Canada survey that was released out on Monday. So the business sentiment fell in Q1. A record number of Canadian firms expect significant increases in prices as they pay for goods and what they charge customers as a result of labor shortages, supply chain constraints, and robust consumer demand. We've got about 12 minutes just remaining before the release. So one of the key issues here with the business sentiment, again from the business's point of view, demand, and particularly for crude oil, where there is a need for more hiring to fill up that space and fill up that demand. If that's not being met, that of course is going to push up the prices of other goods that are made from oil, but also other raw materials too that are used. So you've also got to think about other raw materials. So machinery that is made, also metals, with the nickel prices, what we've seen reaching all-time highs towards the beginning of the Russia-Ukraine conflict. Those are the other factors that are weighing in on business sentiment in Canada as well. Is if there is a pickup in demand, there is a pickup in orders, but there aren't enough people or workers to fill that demand. That's adding to pressure in the economy. So if we do get a more positive figure, I think will still play into the hand of the Canadian dollar, seeing strengthening as we'd seen in the past, and we'll get to that very shortly. But that's just one thing to bear in mind. So investment bank views, where do they see the, what do they predict or expect, let's say, for the Canadian employment change data? So the employment change, S&P Global sees 9.3K, and the unemployment rate with a prior of, with their estimate of 5.6%. And then the investment bank, Canadian Imperial Bank, or one of the banks here, so employment change, they see 100K, with the unemployment rate falling to 5.3%. So overall, both the S&P Global and the Canadian Imperial Bank are seeing a decline in the employment, or the number of jobs that are added compared to the prior month. Whereas you have the S&P seeing an increase in the unemployment rate. And on the flip side, you see the Canadian Imperial Bank seeing a decline in the employment rate by about 0.2%. So one thing I want to go through now is the deviations, and then we'll also look at the previous market reactions as well, and that's quite key for what I want to show you guys. So if we're going back, so this is what I've put down here. So the prior report, there was about 209k deviation, and off of the back of that, what we had seen was about a 30 pip move towards the downside on the dollar CAD. CAD JPY saw about 19 pips towards the upside. GBP CAD saw the strongest moves in terms of pips, of about 33 pips towards the downside, and the Euro CAD saw about 27 pips towards the downside as well. A reminder, the unemployment rate was also came in much better than expected. So usually, from what we've seen in the past, and what we're usually expecting, is I think at least 100k, or at least 100k deviation from the forecast figure. So what we're looking for. So that's just to compare to what we've seen in the past, where we've got to around nearly 100k of a deviation, and we've seen stronger moves in the currency pairs. So again, that was 10 minutes into the release back in October 8th. So we've seen about 39 pips down altogether in the first 10 minutes. But overall, with at least 100k deviation, we see a bit of a stronger reaction from the markets. Whereas see here, while we had about a 30k deviation, we had a reaction on the dollar CAD, similar to the other releases that we had later on. But the other currency pairs, so as the CAD JPY or the GBP CAD, Euro CAD, didn't see that much stronger, didn't see that strong of a move compared to the compared to the other releases that showed at least about 100k deviation from the forecast figure. Now, one thing we've also got to bear in mind is that with the unemployment rate, usually with a 0.3 deviation in the unemployment rate, or at least what we can see here from what we've seen in the past, then if we see more of a positive figure for the unemployment rate, that can help bolster the Canadian dollar's strength. But on the flip side, if we see a more negative figure, i.e. a higher figure comes in of at least 0.3% for the unemployment rate, that could mean that if we do get a good employment change figure, that could mean we could get a little bit more whipsawing on the initial release. But overall, looking for about 100k at least for a stronger move on the Canadian, or from the Canadian dollar, from what we've seen in the past. Okay, so let's go through the past of what we've seen. Let me get the prior reaction of the release here for you. So okay, it's about 5 seconds to the release. Let's see what happens. Okay, so the data came in much better than expected. Ooh, shut that down. I think I had an issue with my feed here. So there we go. So the dollar CAD did see some move towards the downside. Let's get the other ones going. Okay, so and also the CAD JPY. So overall, much better than expected figures overall. We'd seen a weakening on the dollar CAD or strengthening from the Canadian dollar overall. The Euro CAD did see movement towards the downside there, and the CAD JPY did see movement towards the upside. Again, with the deviations, as said, we had seen the dollar CAD see about a 30 pip move towards the downside. CAD JPY about 19 pips up towards the upside. And then on some of the other, and then on EuroCAD about 27 pips towards the downside as well. And GBP about 33 pips towards the downside. So just to bear that in mind, with the, again, that was a really good it smashed the forecast figure by quite a bit. Again, about 210k deviation. And that's where we got a nice strong reaction, but at least 100k deviation from what we've seen in the past. We're looking for potentially for more positive figures for Canadian employment data, more of a strong reaction, similar to this reaction that we had here back in March 11th. Okay, so we got about 4 minutes left until the release. So let's get our charts going. So again, overall, a nice strong reaction there. We keep going. Right, cool. Perfect. Stop that there. All right. Let's get to our charts then. Let's have a little look. Okay. Get that all set up again. So is everyone clear on what we're expecting overall so far? Is there anything that's confusing for anyone that's joined or hopped on at all? If there is anything that is a bit confusing, do let me know in the chat. Remember, with Macro Ace as well, you can sign up to our mailing list to stay up to date, and also be able to watch the replay of this video that we have today, or that we're going to have today. Now, the Macro Ace mailing list, what we usually tend to do is provide an update on what to expect for the week ahead and the releases that we'll be covering as well. So if you want to stick to the schedule that we have, and if you like the content that we've provided, then definitely sign up for that there, which is in the link that I've provided. Okay. All right. Let's get that going. I'll move that. Okay, about a minute left now till we get the release. Whoops. Right. Mr. CAD, EuroCAD. Let's get GBP CAD here. Just keep an eye on what's currently moving the market at the moment. CAD JPY. What's going on there? All right, less than a minute now to go until we get the release. is our USD CAD. Okay. Okay, 72.5k, lower than the forecast of 79.89k. That's much. And then the Canadian unemployment rates, in line, near enough in line with the expectation of 5.3%, lower than the forecast of 5.35%. So, did see some movement towards the downside on GBP CAD and dollar CAD. Now seeing some movement towards the upside on the dollar CAD. So didn't get our 100k deviation on the forecast figure for the Canadian unemployment change, either way. So about a 5.3k deviation is what we'd seen there. So very mixed reaction in the markets here. Canadian average hourly earnings worse than expected at 3.7%. Forecast was 3.73%. Participation rate more or less just in line with expectations. What else are we seeing? So again, yeah, unemployment rate falling by 0.2 compared to the prior. The Canadian employment change, not really huge deviation. So didn't really see, as said, seeing that whipsawing and a weak reaction from the Canadian dollar. But nonetheless, let's keep an eye on the actual, well, let's keep an eye on how much the market moved, or the currencies moved. Let's see. All right. Okay, now seeing some weakness in dollar CAD, excuse me. Also seeing some strengthening on the Canadian dollar overall, we can see. So initially, there's about 4 pips towards the upside on the dollar CAD. Okay. And then also one thing to bear in mind, and I'll go through the other bit of reactions too, where we had seen some initial move towards the downside on the dollar CAD. Okay, and about 9 pips towards the downside on GBP CAD. All right, so let's see how much that initial movement was. So that's about 4 pips. I'd probably see about 7 pips maybe, or 6 pips. Yeah, okay, about 6 pips towards the downside there. So the initial reaction we'd seen some movement towards the downside on the dollar CAD, and then a bit of movement towards the upside. More or less, just seeing whipsawing here. It's not even 5 minutes yet. We've got a couple of minutes to go till we kind of see what the direction is. Let's keep an eye on the CAD JPY. What was the movement there? Okay. Yeah. Right. Again, about 6 pips towards the upside there. All right, so that didn't look too fun. Although the unemployment rate was much better than was slightly better than expected, which is a good thing for the Canadian economy overall. But could this play into the central bank's tightening of 50 basis points for next week? I think in their point of view, they'll see it as a solid jobs report, where the jobs are still being added in the economy, and there isn't a decline or a huge decline on a consistent basis in the economy. So you've also got to factor in, as said, inflation being at an all-time being high since 1991. That's also going to play into the central bank's hand of reining in inflation. Also from the shock from the Russia-Ukraine conflict having an overall effect on energy prices as well, leading to higher inflation. Okay, so 6 pips towards the upside on CAD JPY, 9 pips towards the downside on GBP CAD, and about 4 pips towards the upside on dollar CAD. But there was that initial move towards the downside of about 6 pips towards the downside. But overall, it didn't meet our 100k deviation, at least for the employment change figure, and we didn't get that other bit of data to support it of at least 0.3 or 0.3% in the or for deviation in the Canadian unemployment rate. So overall, a 10 release there. Let's have a look and see how much the Canadian JPY is up by. So overall, up about, so CAD JPY up about 0.3%. Excuse me, 0.30%. If we look at the dollar CAD, dollar CAD flat. So again, there was a bit of a little whipsawing there, but then reaction is now dead. Okay. Any questions so far? Remember, I have posted the mailing list link for you to join. If you did find this useful, then you can sign up to that mailing list and let me know. And also let me know if you found the information that I provided useful for you as well. Other than that, thank you very much for joining me if you did. And I will see you next week. Reminder, as said, Sundays is when I usually put out the week ahead prep. So that'll be given then. But for now, take care and goodbye. Oh, just to remember, talking about prep and what to expect. So next week we have the US inflation report on Tuesday, and I'll be starting about 7:45 a.m. Eastern time for that live stream. Wednesday we have the EIA inventories as usual. At 9:15, I'll be going through the Bank of Canada rate decision data, and then Thursday we have the ECB rate decision as well, with the deposit rate and the main refinancing rate as well, or the interest rate in the European Union. All right, thank you very much, and goodbye, and take care.